my top 4 dividend stocks in the consumer staples sector. This is actually one of my favorite sectors in the whole stock market, so let's get right into it. Coming in at number 1, we got Walmart, which is one of the biggest retailers in the entire world, probably number 1 in the United States. They provide all the essential products at their stores like food and household products. They also own Sam's Club, which is a wholesale club membership where people need to have a membership to go ahead and purchase food at wholesale prices, which I think is a pretty key part to Walmart. Also, taking a look here at their highlights, they were able to implement next day delivery on over 75% of the US population. And in my opinion, that's really good for the online business of Walmart, especially comparing it with companies like Amazon. And also they got over $25 billion in operating cash flow. And that number is actually pretty consistent and growing, which is another key part to Walmart that I really like. And speaking of dividends, they actually have been paying and growing their dividends for 47 consecutive years. I will say though, they do grow their dividend at a pretty slow rate, about 2 to 3% each year, but still nonetheless 47 straight years of consecutive dividend growth. That's pretty good, and it definitely earns a spot in many dividend portfolios. So talking about their current dividend right now, they're paying $2.16 per share. And with the current share price of Walmart, they're currently yielding around 1.83%, which compared to their 4-year dividend yield average, it's actually lower, which means you probably could have gone a better opening yield over the last 4 years. And right now it's just a tad lower. So right here, I got Walmart's earnings for the next upcoming 4 quarters. And if we take a look at the forward PE based off these analyst estimates, we see that Walmart is projected to earn about $5.04 for the upcoming 4 quarters, and that actually gives them a forward payout ratio of 43%, with their dividend currently right now at $2.16. And a 43% payout ratio is definitely a very good payout ratio. It's in that spot where it's very safe and has the ability to grow if Walmart so chooses to grow it at a higher rate. But taking a look at the valuation side, the 5-year average PE for Walmart sits at around 23. And currently right now, if I would like to buy Walmart at a 10 to 15% discount from that 23 PE, I'd be looking at a 20 or 21 price to earnings multiple for Walmart. And that's actually a 100 to 104-ish price point on Walmart at a pretty good discount. I mean, right now it's trading at a 23 forward PE at this 117 range, which could mean the stock is actually pretty fair valued, and it wouldn't be a bad idea to open up a position. And that's actually what I've been trying to do with Walmart. As you can see, I do own 2 shares with an average cost of $119. Now, generally, I like to open up my positions at a 10 to 15% discount from what I think is the intrinsic value of a stock. But with a company like Walmart, sometimes you just don't get those opportunities, since this stock is a very reliable and a very good stock. Usually their prices hold up a little bit more, and very rarely do you see a discount. So I went ahead and I started a position fairly early. As long as the stock continues to drop, I'll definitely be picking up more shares. Now, taking a look at Walmart's earnings growth for the next 5 years, they do have a projected growth rate of about 5.5%, which is definitely in line with what I like to hold as a stock. Moving on, we got Clorox, which is the manufacturer of consumer and professional products worldwide. And with Clorox, it's all about the brands that they owned and their position in the markets right now. If we take a look at their portfolio, we can see that they own a lot of well-known products, and they have pretty good market share when it comes to the different industries that they participate in, like cleaning, household, international, and lifestyle. And their biggest brands right now is the charcoal brand under Kingsford and their bleach products under the Clorox name. So this is definitely a great brand name. And one of the caveats to Clorox is the private label brands. However, I have used private label brand products before and compared them to Clorox products. And honestly, Clorox products, not just because I'm a shareholder, but they really do have superior quality on almost all the industries that they participate in. So private labels is definitely something to look out for, but I do think Clorox has really strong brands that can continue to do well in the US and international as well. So taking a look at their dividends, they've actually been paying and growing their dividends for 18 years. They were able to maintain and grow their dividend throughout the 2008 recession, and so far they're doing really well as a stock. If we take a look at their current dividend right now, they're out to pay $4.44. And with their price just above 200, that gives them a yield of around 2.16%. And compared to their 4-year dividend yield average, which is actually pretty low compared to that 4-year average. And if we take a look at the earnings that we have here, it kind of shows the same picture. So again, here we have the upcoming 4-quarter estimates for Clorox and their earnings, and they're projected to do about $7.09. So as that relates to their dividends, they're actually pretty safe. They're at 63%. It's one of those percentages where it's not that good for dividend growth, but it is good as far as safety. Now back to the valuation, their 5-year PE ratio is about 24 on this stock. And currently right now, if I would like to buy more shares of this company, I would like to buy it at around a 20 to 22 PE, giving me that nice 10 to 15% discount. But take a look at the prices. That would mean that the stock would have to drop from 205 all the way down to the 150s. And honestly, that's a huge drop, but they are trading at a 29.30 forward PE right now, which I think is definitely overvalued. And I do have a small position in Clorox, which we can take a look at here. I have 3 shares at around $147. It's always nice to see your position in line with what you think the value of the company is. But right now at 205, I think it's definitely not a buy. I wish I was able to buy more shares at this price point, at this 150 level, but I wasn't able to. If it does drop in the future, I will definitely be picking up some shares. And now lastly, let's take a look at their growth rate. And for the next 5 years, they're projected to do around 5.5%, just like Walmart. So pretty solid growth rate, pretty solid stock. I like the dividend. The only thing is the valuation right now is not the best. Moving on, we got the Hershey's company. This is the chocolate manufacturer. They have all the great brands for chocolates and different snacks. And taking a look at their portfolio here, they're the number 2 player in the United States when it comes to snacking, and they're number 1 in chocolate market share, which is no surprise. When you have companies like Hershey's, Reese's, Almond Joy, you basically have the best chocolate brands out there. And one of my favorite parts about Hershey's alongside with the brands that they own is their international market potential. Currently right now, their international sales sits around 10 to 11%. I really think Hershey's could grow their brand to around 15-20% of their sales coming from international markets, and that's definitely a bright spot for Hershey's and a growth potential for them as well. So taking a look at their dividend right now, they have been paying and growing their dividend for 11 consecutive years. However, it could be a lot longer if it wasn't for the 2008 recession. This was a company that just maintained their dividend from 2007 to 2009. It's not a bad thing because they were at least able to pay out the dividend, but they were not able to increase it during that time, which is fine for the most part. And now taking a look at their current dividend, they're paying out $3.09 right now per share with a price of around $130. That gives them a yield of about 2.4%, which is actually in line with their 4-year dividend yield average. But if we take a look at the earnings, we could see a good opportunity to enter in the Hershey's stock. So right here for their forward earnings per share, we have analysts expecting about $5.86. And with regards to their dividend payout, they have a 53% payout ratio, which is really good. That's a good payout ratio to have when you're growing your dividend and a safe payout ratio to maintain the dividend. So going back to their valuation, the 5-year average PE for Hershey's is at about 26, which is not too bad considering the fact that Hershey's has a little bit more growth than Walmart or Clorox. And when we're talking about price points for me to enter, I would actually like to enter around this price point, actually around 123 to 130. That gives the stock a forward PE of around 21, 22, and that would be a nice discount from the 5-year average multiple of 26 on Hershey's. So this is a stock that I actually own right now. I have 3 shares at around $142 each, and honestly, I bought this stock a little bit too quickly. I bought it before the pandemic, but even then when I did purchase it, it was a little bit pricey. I didn't really get the discount that I usually like to get with these stocks. And right now, since it is trading at around $130, this is a great opportunity, at least for me, to go ahead and average down my position and get that average cost lower. And lastly, let's go ahead and take a look at Hershey's earnings per share growth rate for the next 5 years. And they're actually projected to do almost 7% over the next 5 years, which is really high, especially for a consumer staple stock. So lastly, we got PepsiCo. This is the last company on the list. And PepsiCo is one of the biggest companies when it comes to food and beverages all around the world. They own some of the best brands, honestly, in Pepsi, Gatorade, Quaker Oats, and a solid portfolio all around. So moving on to their dividend, PepsiCo has been paying out a dividend for 48 consecutive years and growing that dividend, which is absolutely crazy. They're in line with Walmart, but they actually have a higher growth rate, which makes it just that much more impressive. And looking at their current dividend right now, they're paying just over $4 a share with their last close price of around $129. That gives them a starting yield of 3.17%, which is actually higher than their 4-year dividend yield average. But when it comes to valuation, honestly, I really think Pepsi is a little bit overvalued. So let's go ahead and take a look at their earnings. We have the PepsiCo's forecasted earnings for the next 4 quarters here, and they're projected to do $5.42. And with their current payout of $4.09 per share, they actually have a really high payout ratio of 75%. I still think that they're going to be able to grow it year after year, but I definitely think that they're going to lower their growth rate and not grow their dividend as high as before. Now, going back to the valuation on PepsiCo, their 5-year average PE is about 23, and for me to purchase this stock, I would like to see it at around the 106, 112 level, which is a 20 to 21 PE. And currently right now it's trading at around 130, so it is a little bit pricey right now. So taking a look at PepsiCo's 5-year chart, they've done pretty well as a staple stock. They've grown around 38% over the last 5 years, which is not too shabby. I don't own the stock just because it's always been a little bit pricey and their price appreciation is not really there compared to the other stocks. Now, their earnings growth rate for the next 5 years is pretty solid, just under 5%. So those are pretty much my top 4 defensive stocks for the consumer staples sector. We got Walmart, Clorox, Hershey's, and PepsiCo. Hopefully the video was helpful, and thank you so much for watching.